So you did it. You started an LLC. That's awesome. But now comes the big question. How do you actually pay yourself? Because, how you get money out of that business and into your own bank account is one of the single biggest financial moves you're going to make. If you get it right, you can legally save thousands, maybe even tens of thousands on your tax bill. But if you get it wrong, well, you could be leaving a ton of your hard-earned cash on the table for the IRS. Okay, let's get into it.
For most business owners, believe it or not, taxes are their single greatest expense over their lifetime. And there's this one kind of hidden cost that catches almost every new entrepreneur completely by surprise. So what is it? It's this number right here, 15.3%. This one little number can become a massive financial anchor, seriously dragging your business down before you even get a chance to really get going. What we're talking about is the self-employment tax. See, with a standard LLC, you're on the hook to pay this 15.3% tax on every single dollar of profit your business makes. And here's the part that really gets people. That's not just the money you pay yourself. Oh no, it's a tax on the entire profit of the company. But hang on, before we even think about solving that tax problem, we've got to build a solid foundation. These are the absolute, non-negotiable first steps for protecting your personal stuff. This is the opening play in the pros playbook. It all starts right here with these two simple things. First, you get an employer identification number, an EIN, from the IRS. Just think of it like a social security number, but for your business. Then you take that shiny new EIN to a bank and you open a dedicated business bank account. From now on, all business money goes in and all business expenses come out of that account. It sounds simple, but it is so critical. So why is this such a big deal? Because the whole reason you got an LLC in the first place was to create a legal shield, right? A wall that separates your business life from your personal life. Well, these two steps, this is what actually builds that wall. And this is where things can go really wrong. When you start mixing funds, that's called commingling, you are literally taking a sledgehammer to that legal protection. In the eyes of a court, if you treat the business account like your personal piggy bank, that shield you thought you had, it can just poof, disappear. Okay, so with that foundation in place, let's talk about how most single-owner LLCs start out paying themselves. It's the default method, and you've got to understand both its awesome simplicity and its really significant drawback. It's called an owner's draw, and it's as simple as it sounds. You just transfer money. You draw it from the business account right into your personal one. It's super flexible. You could take $1,000 one month, $10,000 the next. Sounds pretty great, right? Well, here is the massive catch. That transfer is not a business expense. Your LLC gets zero, zip, nada as a tax deduction for paying you. This is the exact trap that so many entrepreneurs fall right into. Let's just run through a quick example. Let's say your business knocked it out of the park and made $100,000 in profit, but you were being smart reinvesting, so you only transferred $40,000 to your personal account. Guess what? The IRS doesn't care. You owe taxes on the full 100 grand. And yeah, that entire profit gets slammed with that 15.3% self-employment tax we talked about. So how do we fix this? How do we get around that? This is the pro move. This is the second part of our financial framework, and honestly, it is a total game changer. It's a simple tax election you file with the IRS that tells them to tax your LLC in a completely different and much better way. By making an S-Corp election, you're not just the owner anymore. You're also an employee of your own company. This is huge. It lets you split your income into two buckets. You pay yourself a reasonable salary, and only that salary gets hit with those payroll taxes. The rest of the profit, you can take that as a distribution, which, and this is the key, is not subject to those heavy self-employment taxes. Let's look at some real numbers here, because this is where the strategy just pops off the page. On $200,000 of profit, a default LLC is going to pay over $30,000 in self-employment tax. Ouch. But with an S-Corp election and a reasonable salary, that tax bill can plummet to under $7,000. Yeah, you heard that right. That's a potential savings of over $23,000 in a single year. For a lot of profitable businesses, this one simple switch can put tens of thousands of dollars right back into your pocket. It is one of the most powerful tax strategies for small business owners out there, period. Now, there is one really important rule here. The key is that your salary has to be reasonable. The IRS is super clear about this. You can't just pay yourself like $1,000 for the year to avoid taxes. It has to be a defensible number based on what someone in your industry with your experience doing your job would actually get paid. All right, let's move on to the third and final part of our financial framework, using strategic deductions as wealth accelerators. These are some powerful write-offs that, honestly, most business owners completely miss. There are just so many opportunities here. We're going to talk about the Augusta rule in just a second, but you've also got the home office deduction, Section 179, which lets you deduct the full price of qualifying equipment in 1 year, and of course, business meals. Heck, even something as simple as putting your company logo on a polo shirt can turn it into a deductible promotional expense. Okay, this one is one of my absolute favorites. It's called the Augusta Rule. It basically lets your business rent your personal home from you for meetings for up to 14 days a year. And here's the magic. Your business gets a tax deduction for the rent it pays you, and you personally receive that income completely 100% tax-free. It's an incredible win-win. So let's just pull this all together for a second. When you really look at your LLC finances, it all comes down to having a simple, proactive plan in place. And here it is. This is the entire playbook, simplified into a 3-step framework. Step 1, build the foundation with that EIN and a separate bank account. Step 2, pay yourself smart by seriously considering the S-Corp election. And Step 3, deduct strategically. Be proactive about tracking and writing off every legitimate business expense you possibly can. And all of this leaves us with one final thought. You can either reactively file your taxes every year and let them be your single biggest expense, or you can proactively plan for them and turn them into one of your most powerful tools for building wealth. The choice